So I am going to be talking about falling knives, and that is going to be talking about specifically figuring out when is a deal too good to be true in investing. So I don't literally mean a falling knife in the sense that you're in a kitchen, someone's dropped a knife and you try and catch it and it's going to stab you through the hand like this unlucky fellow. That's not what I'm going to talk about. I'm going to talk about it in the context of a sharp or rapid drop in price of an equity. Now, there's no particularly defined magnitude of a drop or duration of the drop that it has to be considered a falling knife, but it's just a large drop in the price of a stock that you're looking at. And the idea behind it is that you might buy it thinking that the drop is over, the price has come down, it's a better investment now than it was before, and then the price keeps coming down and you end up getting cut and end up losing money, potentially selling for a loss. So that's the general idea of a falling knife. And now I want to talk about how we as lead pass investors, and particularly myself, can go about dealing with it. This might be a stock you're looking at, TIRX, for example, I talked about recently. This sort of drop here, where it went from $100 to $20 over the course of just about a week. One investor at $50 might have looked at it saying, wow, that's come down 50%, should be an easy buy here, it's going to rebound, and then lost loads of money over the next couple of days. How do we know what to do here? How do we handle this? Well, the first thing we need to do is not just buy in, as I've said, not just buy in because it's dropped. We want to know why it's dropped. And more importantly, we need to know what the value of that company is so we can buy at a safe price. We've talked a lot about margin of safety during the course of these presentations. And it's the idea of buying a company way below its true value to provide ourselves with a safety buffer in case we've done any incorrect analyzing of the company, and to minimize the chance of it dropping further. You know, the further we think it's getting below its true value, the less likely it is to keep dropping. It's not to say it definitely won't, but it just reduces the likelihood. That means that with a company like Adobe, which I think is a fantastic company, I can't buy it at the moment because it's way over that margin of safety price. So even though it's not dropping currently, it could, and I could end up getting burned and losing a lot of money. Now, there's something called market theory, and that's the idea that markets take into account all relevant information about a company. So if it's trading on the stock exchange, everyone already knows everything there is to know about it collectively, and therefore it's priced correctly. If that were the case, how would we ever find a stock way below margin of safety that isn't a dangerous investment for us? Well, let's take a look at that. Let's start with GamesWorkshop. Now, we did this as one of our first presentations of a company that we think is fantastic, and we said it was below our margin of safety value, or at least it used to be. So this is a stock chart showing GamesWorkshop's price movement about a year and a half ago, and in the green area is where I consider the stock to be under what I've evaluated as its margin of safety. And the red area and up is above margin of safety. So not necessarily overvalued yet, but just too expensive for me to buy. Now, when I first analyzed GamesWorkshop, I was somewhere in this area on the left-hand side of the graph. And as I got money and started saving using the sort of strategies that Adam talked about in his previous presentation, I started buying up GamesWorkshop through this golden highlighted area. And I can be confident of doing that because the stock was going on the up. I'd already done the analysis. I'd taken into account all publicly available relevant information. I knew that the company was undervalued with relation to that. And therefore, I could be confident that I wasn't going to get burned by a sudden drop. And if there was a sudden drop, I would be able to buy more and would still be protected by the fact that I was buying so under the true value. So let's contrast that with Adobe. Now, I've already mentioned I think they're a great company, but that they're overpriced. But let's look at what that looks like on a graph. Wow. So this black line here is where I think the true value of the company is. And this green area is the margin of safety area that I would be happy to buy it at to account for the fact that I might be wrong about my calculations. And then way up here at the top is where it's currently trading. So you can see that it would have to have somewhere near an 85% drop to come down to where I would be happy to buy it. Now, what could cause a company to drop 85%? Might be over a few days, it might be over a few months, but something would have to happen for it to change that drastically. And if something were to drop that drastically, should we just jump in and buy it? The answer, of course, to that is no. Don't just jump in and buy something that's dropped 90 or 85% or even 50%. Something has happened that's caused the market to believe that it's worth 15% of what it was the day before or 6 months ago. And you need to know what that is. So you need to go and do your research. You need to pay attention to the news, find out what's changed, whether it's a CEO change, a change in the revenue, missed earnings, whatever it might be. And once you've figured out what's changed in the company, you need to essentially go and redo your due diligence. You need to go and redo that research you did before and apply our lead path strategy, where you look at the 3 pillars of the company, look at its management, at its market position, and at its finances. And you need to know for a fact, after redoing all of that the fundamentals of the company haven't changed and that you're still willing to buy at the price that it's dropped to. Or you need to know that although some of the fundamentals have changed, it is still under whatever margin of safety price you might come up with as a new margin of safety price. So to do that, we need to first address what caused the drop. There's a lot of things that might cause a drop. Some of them might be something like external factors such as inflation rising, which we talked about a lot over the last couple of weeks since it's currently in the news. Tax raises. Joe Biden is planning on raising taxes for corporations in America, which can affect their bottom line and might cause investors to get scared and jump out. Or we could talk about excessive leverage in the markets, which if that were to change, people would have to sell out to cover their margin and companies would drop in price. All of that is quite broad market stuff that would affect the whole market or specific sectors rather than one company dropping. Something that might affect an individual company would be something like a major shareholder selling. So Coinbase IPO'd at a price of about $400. It doesn't show it exactly on here because it jumped about so much. And it's now almost halved in value. That's because a lot of insiders are taking profit and selling out. And that could provide a buying opportunity for us if we think it's coming down to our margin of safety price. We've already given our opinions on Coinbase, so go and check that video out if you like. Now, shareholders selling could be a non-event for us. It could just be someone booking profit. It could be Jeff Bezos buying a $500 million super yacht and selling some of his Amazon stock to cover it. Or it could be an insider who knows something that we don't, realizing that the company is no longer worth what it's trading at and is taking profit while the going is still good. So it's important to do due diligence on those situations. It could be something like a research note. There's a lot of young investment bankers who get quite bored and have to justify large paychecks. So they go around analyzing companies and putting out buy or sell signals on those companies. And they're often just a complete waste of time. Sometimes they'll unearth something that's worth adding to your understanding of the company. But for the most part, it can just give you an easy opportunity to enter. There's something called a whisper number on Wall Street, which is where, although there's an official estimate for what a company's going to get for its earnings, there's also an unofficial estimate that all the people are talking about, all the analysts. And if the company misses that, the stock can drop quite drastically. So Walt Disney here beat its earnings per share estimate by 200% and has come down $20 or $30 per share. That means to me that people were expecting even more than that and has not quite reached the institutional investors' level of expectation. But for us, that could be a perfect buying opportunity if we think the company is great. Finally, could have something like a scandal affect the company. When Elon Musk went on the Joe Rogan podcast and legally smoked weed because it's fine in California, Tesla stock dropped 10% the following day. Now, we could look at this and, as lead pass investors, apply our strategy and go, well, nothing's changed about the management. We know Elon's a nutter. Nothing's changed about the market position of Tesla just because he smoked a joint, and nothing's changed about the fundamentals of the company. Perfect. This is a good buying opportunity. But a scandal could also be something like Mars, Nestle, and Hershey facing child slavery lawsuits. Now, this might have been previously great companies for us to invest in, but now this has come out and it changes our fundamental view of the company. We think that they're going to have to change how they do their practices. It's going to affect their bottom line, or even just you don't want to invest in a company that's exploiting child slavery labor. Personally, that would be my issue with this. So all of that is to say that we need to figure out what's caused the drop and whether it's superfluous news, it doesn't actually affect the company, or if it's going to really change our understanding of it. Now, let's say we've done our analysis and we figure, okay, it's not really going to affect the company. It's a perfect buying opportunity. How do we go about it? Well, I've said we've got to start with the margin of safety, but let's assume it's gotten to that point. We could start by just buying up a certain size that we want to have in our investment portfolio, say 100 shares, and just leave it there. We're not going to worry about what happens afterwards, and we're just going to sit and wait for it to come back up. We could start buying a certain amount every month until we reach that same size in our investment portfolio that we want to have. And that way, if the price comes down further, we get to get even more discounted shares. But we might miss out if the stock starts to go up too early. Or if you're a more technical analysis sort of guy, you could try and predict where the bottom is going to be and maximize your returns. The key about all of these strategies is you have to know what you're going to do if the price keeps coming down. Now, as lead pass investors, we want to know that the company is sound and that it's valued way above where it currently truly is at the moment. That way, if the company keeps coming down in price, we can sit there and secure whichever of these strategies it is, knowing that although our investment account might show a red number for the time being, it's not actually the case. I personally prefer the middle method. I would like to start investing a small amount every month and hopefully get some more at a cheaper price. And if it just keeps coming down, I'm not going to be concerned because I understand the company and I know that it's going to come back up over the long term. So that's how we deal with these falling knives. We do our due diligence, we figure out whether it's actually a falling knife, and if it is, we avoid it like the plague, and if it isn't, we take the great buying opportunity that that dip can provide. Does anyone have any questions about that?
Hi there. Thank you so much for watching our video. I hope you really enjoyed it, and I hope you learned something. If you have any questions, please let us know in the comment box, and don't forget to like and subscribe so you can learn more about our channel. Thank you very much, and see you next time.